Let's bring in Evercore founder and senior chairman Roger Altman, who joins us this morning at Post 9. It's great to see you, Roger.
Hey, Carl,
thanks for coming in. Your general view is that the sledding is tougher and will be tougher going into year end.
Yeah, I think it's going to be hard for equities to do well for the rest of the year. I mean, first we have this step function increase in open market interest rates, and yes, yields are down somewhat today. Treasuries are playing a safe haven role today. But fundamentally, interest rates, as we all know, have risen very sharply. So at the margin, it makes sense to park money in fixed income in a way that it didn't 12 months ago or 6 months ago. And at the margin, that's a disincentive to hold equities. Then monetary policy. We saw yesterday inflation is coming down in a very sticky, slow way. You know, CPI at 4.1, implied core PCE at super core PCE at 4.4. You know, that's a long way from where we need to get to. So the thesis on higher for much longer, it seems to me, on monetary policy is reinforced. Is there going to be another rate hike? Maybe not, but I think the cuts are pretty far off. And then the economy itself, albeit slowly, is decelerating. You see that in temporary employment agencies. You see that in gasoline futures. You see that in housing. Most people don't think there'll be an actual recession, but the economy is slowing some. And then, you know, the market's still expensive. I mean, the forward PE on the S&P 500, I think, is 17.6. And by historical standards, that's still quite high. So the outlook for equities medium term, I think, is tough.
We just got these UMISH numbers where the one-year expectation goes to 3.8, even as confidence falls. Does that smell stagflationary to you?
Well, I think we are going to win this battle on inflation, and the Fed's going to achieve its target at some point next year, maybe second half. So, no, I don't think we're going to have, like the 70s, high inflation and very low growth. I think inflation is going to get down there, but I just think it's going to take longer.
I think we need to replace higher for longer with high for longer, right? Because that's really what we're talking about here.
We're probably where we're going to be on the funds rate. I mean, we'll see. It's data dependent, but I agree. The Fed is probably not going to hike in November, and probably there won't be additional hikes, period, although that's debatable. So, yes, I agree with you.
So this morning, Jamie Dimon in the statement says this may be the most dangerous time the world has seen in decades. He's clearly more worried about the geopolitical landscape than the economic one right now. Are you advising your clients differently when it comes to deals and behavior?
Well, first of all, Jamie is completely right about that. And parenthetically, I think he's probably the best financial service CEO in my lifetime. I mean, JPM is doing so well, you have to take your hat off to them. But on the geopolitical tensions, they're at a real high point. I mean, you have war in Ukraine with the risk of a wider war. You have war in Israel with the obvious risk of a wider war, whether that's Hezbollah, Iran, and so forth. Then domestically, you have paralysis in Washington. You have a completely dysfunctional House. A lot of people don't realize this, but constitutionally speaking, if you don't have a speaker, you cannot, the House cannot act. So if we had a sudden emergency need to pass legislation, they're either going to find a speaker or you're not going to pass it.
Well, so we do when it comes to supporting our ally right now in Israel.
Well, I know, but right now you have dysfunction there of a historical level. So it's a pretty alarming political and geopolitical environment. I think Jamie Dimon is right. And, you know, if you're and by the way, I'd add one other thought. You know, Howard Marks has this theory, sea change, which is that we've now come to the end of a 15-year period of ultra-low interest rates, and investors are just beginning to realize that it means lower returns, different asset allocations, and so forth. I find that to be impeccable logic. And so you add all that up, and you say, this is a tough environment. Why don't I take a little more conservative stance, maybe more fixed income? And that's one of the reasons I think markets, at least equities, are going to have a hard time.